Hello.
Hey,
Hey, everybody. Happy Tuesday to you. Thank you guys so much for joining us today for another Stocks from Scratch deep dive. Two stocks. Stoffel
two
on
stocks.
track for today. These are two of the most highly requested stocks we've had over the last month. So,
And they've been in the news a lot.
Yep, sure have. And last week we kind of did two stocks in one session. We asked you guys, and you guys seemed to be like, yeah, this is way better than just doing one. So we thought we would do two. But as always, we are interested in your feedback as we go. And what stocks are we talking about today, Stoffel?
So we are talking about what is commonly referred to as neo clouds, Nebius, which, believe it or not, used to be Yandex, and IREN, which I believe used to be Iris Energy and has made a complete pivot from crypto to AI.
Yeah, these are companies that have completely transformed their businesses and business models in the last couple of years. So researching them is going to be particularly challenging. I've taken a look at Nebius already, and the financial statements are kind of a mess. And with IREN, the financial statements are also not indicative of what the company is pivoting towards. They're more about
because it's all
where it's been
crypto looking
historically.
backwards,
Right.
and it's all AI looking forwards.
Yep. But let us know in the chat, do you own either of these stocks? Now, we like to think about stocks on a difficulty scale. Some are
Definitely
easy,
know where this is going.
some are medium, some are hard, some require expert level financial knowledge. What do you think is my guess for how these companies are?
It's a double diamond, double black.
100%. 100%. These are, this is, to me, as hard as it gets when it comes to analyzing companies from scratch. But I do know that these stocks have done fabulously well, and they're growing like mad. So to do this, we are once again, we're going to be showing off the new look of Stock Simplifier. This is still a behind the scenes look. We are launching this to our premium users tomorrow. So premium users, you will get access to this new look tomorrow. We're doing a special webinar. I sent that email out to everybody. So we hope that you join us. So thanks for your patience with that. So this is very much still in beta mode. We're still polishing out all the bugs. So if we see a bug as we go, we will fix that before tomorrow. But anyway, here we are. Nebius, it's on the NASDAQ. It's in the Netherlands, and I see information technology. This is a $52 billion market cap company. And if you look at the chart, wonky things here, nothing, and then the chart kind of picks up again. So again, this was a spin out, right? Or
so Nebius used to be Yandex, and Yandex was the Google of Russia. The same team that founded and ran Yandex, when the war started, relocated everyone to the Netherlands. They were always officially in the Netherlands, but they relocated everyone to the Netherlands. They sold off their Russian search engine business, and this is what they pivoted into.
Okay, so take a look at some key stats here. It says 2004. That's going to be
that's when Yandex was
Yandex, right? So again, the numbers here are going to be a little wonky to look at, but it's about 68% gross margin, negative operating margin, positive net margin.
We'll have to look at that.
Yeah, I have a feeling that that's an artifact and not indicative of the business.
Now, Brian, it is worth pointing out what's at the very top of the screen. This is a stock that's up 14% today. And I believe it's because NVIDIA announced that it has a 9.3% ownership stake. And I think it had a previous ownership stake as well. So it's being added to here.
Okay. I saw something about that this morning when I did a quick search, but let's start diving into the business and see what we can learn. Nebius sells AI cloud computing, renting out the machines that train and run artificial intelligent models. Okay. So their AI cloud platform, it builds and operates data centers full of graphics processing unit servers that then rents that computing power plus the software layer that make it usable. AI data provider play.
Just real quick, because this might help people understand this. This is basically, this mimics what Meta is saying they're going to do. Like Meta has built out all this AI capacity, and they were doing it to use in-house. But my read on the situation is that Meta has gotten so many offers that are so good that they can't turn down, that they're looking at these data centers that they have that are full of NVIDIA GPUs, and they're like, we could go ahead with our own plans, or we could take all this money and just rent out what we have, which is why when Meta made that announcement, players like Nebius and IREN and CoreWeave fell so much because they were like, oh, they're going to come in and do this. I don't think that's the whole story, but just to kind of frame this.
Got it. That's very helpful. Okay. Capacity is being built ahead of demand. Land, electrical power, and chip supply must be secured years before it arrives. So the company works from contracted power to connected power to active power. 2 smaller businesses. So Triple 10 reskills people for technology careers for a fee, and AvRide develops self-driving vehicle and delivery robotic technology.
I don't even know about that.
So this is a visual change we just made. I hope you like this. With one quick view, we can see, well, 90% of their revenue is the Nebius stuff. 10% is that Triple 10. And then AvRide is $1 million. So we have this nice quick view that you can get a quick sense of if the company has multiple segments, which one is the most important. In this case, we don't have growth rates. I'm guessing because of, again, the financials are a little messed up, but you can flip this over and it'll show you the growth rates of each of those business components. So you can see which is driving it. Okay. What makes it distinctive? Nebius designs its own servers and racks rather than buying them, engineering them to run hotter. So they air cool at high density, which is how it undercuts general purpose clouds on cost. So they design their systems to run at higher temperatures.
Now, it is worth also noting that within the last 10 days, they also said that they're going to start a new business model. It's unclear if this is going to take off, where, as you might expect, this is very capital intensive. If I want to go build a data center, fill it with NVIDIA chips, heating, cooling, land permits, all those things, that's going to cost a ton of money up front. But Nebius announced that they were changing their business model, or introducing a change to their business model Is this
the announcement?
Right. And the idea here is that they don't front all those upfront costs anymore, which is a massive deal if that takes off. It's too early to know if it's going to take off.
Okay, so they today announced a new business model that lets infrastructure partners deploy their full stack on their own centers. The model brings additional capacity and expanding at a time when demand under the model. Partners finance and own the infrastructure and hardware and operate the data centers.
So you might be like, what does that Nebius do?
They supply the system architecture, the supply, deploys and maintains the design and software stack, and takes the resulting capacity to market through its global sales organizations. Partners get the fully owned infrastructure, designed to Nebius' standards and fast route to AI. Nebius takes the raw capacity into production-ready cloud. Nebius connects it to the customers. Because Nebius brings the demand, partners can begin generating return as soon as the capacity goes live. So it's almost like they're looking for REITs, for lack of a better word, to finance everything, and then they're just you get to plug into their network that buys it.
So the big question is this. So the let's do the both sides of the coin. The positive side of the coin is this requires much less capital. They don't have to go into debt. They're not on the hook if they do this at scale. And that's great for lowering your downside risk. The flip side is, how much of a moat is there around them basically doing the non-infrastructure heavy stuff? I don't know that.
Yep. And again, that came out a couple of days ago. It's obvious why it's not in here, because this is essentially, hey, we launched a new business that we have zero revenue, zero financials. It's almost the idea of a business. And once it starts to show up in the financials, then it'll be a part of this. Again, this is a complicated business, complicated story to really understand. All right. Customers. The buyer is anyone who needs a large amount of AI compute. So the AI labs and model builders, they need, obviously the model builders, enterprises, data scientists, and career changers. A separate consumer audience buys reskilling courses through 1010 aimed at moving them to technology jobs, paying the platform directly. So that's their minute businesses here. New visual here to show you the by geography. The US is 64% of revenue. UK is 28. Rest of the world, 9%. So 340, 138, and 52. Nice visual there to show you where they're getting the revenue from. Then quality questions. How predictable is revenue? A 5-year, $12 billion Meta compute agreement plus prepaid billing on the segment that is 89% of revenue means much of the top line is committed well ahead of delivery. That's great to see.
Yeah.
The Meta agreement.
Now, it's also worth noting that when NVIDIA buys a stake, NVIDIA is introducing some circular financing here, because how is Nebius going to buy those GPU clusters with the money they just got from NVIDIA?
Of course. Nothing new, nothing on that side. Okay. Can the company raise prices? Nebius competes by undercutting rivals on total cost of ownership in an intensely competitive market, selling capacity built on the same NVIDIA chips. So its product isn't that differentiated, but it's undercutting them by allowing the servers to run hotter. So which is a huge input cost, right? The electricity going in there and the cooling. Okay. But can it raise prices? Well, its whole strategy is really keep costs low.
Yep.
How recession proof is it? So this says weak. It's built on their CapEx budgets and durable, but for the foreseeable future, this is recession proof to me. In competitive position, average, one of the few global cloud providers purposely built for AI and growing very fast off a small base, but explicitly subscale against better resource rivals. Yeah, no doubt about that. All right. Complicated business. But at least
I think for this one, you can go ahead and put what you think. We don't need to take a poll on this one.
To me, it's fine. It's exciting. It's likable. All right. Step 2. Is this what phase it's in? The AI is saying it's in phase 2, the hyper growth phase. Now, again, this is the spin out, right?
Yeah.
So the 4.8 billion
That's Yandex.
14 million isn't that much, and then it's growing, but 14 million to 878 million over the last 4 years. Operating cash flow.
You think that prepayment is a big deal?
Yeah.
Look at that.
Oh yeah. Right. So again, complicated stuff here going into the financials. This is saying it's not profitable, but this is saying operating cash flow is a positive number. A lot of accounting stuff going on here to kind of figure that out. Yeah, it was buying back stock previously. It
had a over the fourth quarter of last year and the first quarter of this year, it had roughly 4.5 billion in prepaid revenue. Most of that, I'm guessing, from Meta.
Okay.
4.5 billion.
But their cash flow was negative, right?
No, their operating cash flow was very positive. Their free cash flow was negative because they took that prepayment and just put it into physical assets.
Yeah. Okay. Revenue is hugely growing. It's due to Nebius. They're capacity constrained. The geography mix is narrow. The industry metric is asset light. That might be, so the way that we figure out the profit metric to look at depends on what industry the company is in, but this is a company that's in a IT services, historically a capital light business. Again, this company doesn't fit neatly into a boxes. It's almost more of like a REIT right now. And that's, it's going on there. God, this is why
it's a double diamond. It's a super hard company.
Yeah. The share count is rising again. How much capacity is it operating? All right, let's go over to fiscal and take a look at some of the financials here to see if we can get some more.
And I would even put it on the quarterly view just because things can change so quickly.
Okay. So what do we see here? It's in standardized. Okay. So
that's fast growth.
Let's shrink this down.
In March of last year, it was 51 million, and now it's 400 million.
Revenue is growing like crazy. Positive gross profit. So gross margin is positive. Operating margin here is hugely negative, right? So these numbers are negative. So that's why, okay, look at the operating margin here. Negative, but trending up. So based on that, Stock Simplifier is absolutely correct. This is a phase 2.
Yep.
This is a phase 2 company. I have a feeling there's going to be some really wonky things somewhere that's thrown. Yeah, look at net income is positive 620. Okay. Non-operating income. Non-operating income is positive $800 million. So this number here is making net income go crazy. So the company is losing money on an operating basis, but it has this non-operating number, which is
it's a gain from a revaluation of investments in other equities.
So they own stock in other companies. I wonder if that's the index they own stock in.
I don't know.
Whatever it is, right? So we need to look at the core business. The core business, phase 2. That makes sense to me. Whew. Complicated. Moat. Contracts and an in-house hardware cost edge are real, but neither closes the market to rivals, which leaves a thin moat. So there are contracts, multi-year contracts, which create friction. The cost edge is unproven. So they're saying their in-house servers have a design which lets them run hotter, but they don't have a multi-year margin track record behind it. They do have margins, and the returns show nothing yet. Okay, it's being conservative with that, which is fine with me. The moat is widening. The new lock-in is being written, 5-year commits capacity that signed this year that did not exist before. The active power is nearing 170 megawatts against 2 gigawatts have been contracted, and nothing is eroding. So there are 5-year contracts in place that make it somewhat hard to switch. It's saying it has a cost advantage because their servers can run hotter, but no multi-year margin track record at all. So it's
is that hard to mimic?
I don't know.
Yeah, I don't
hard to say. I'll say thin and I'll say growing.
That's exactly what I was going to say.
Yeah, that makes sense to me. Growth analysis. Well, this will be fast. Analysts expect revenue to grow 537% next year, and then way more after that on the people covering the stock. So yeah, ignore this earnings because of that non-operating thing. So the earnings here are a mess. Just focus on revenue. And I think if we go back to fiscal and we just look at, if we go annual, and then we draw this out to being, come on. I've clicked on the right line. That's why. There we go. I have to turn off quarterly. Oh, that was non-operating. There you go. Yeah. Look at this growth.
Yeah.
800 million trailing, 3.3 billion, 12, the growth is going to be absolutely insane over the next 2 years. Don't even need to go much further than that. Management. It's founder-led with an 11.
Remember, this is the guy that founded Yandex like 20 years ago.
And positive employee reviews set against missing revenue and analyst expectations in 5 of the 6 quarters, and unremediated internal control weaknesses. Internal control weaknesses. So the founder is there. He has real skin in the game. He owns about a $3 billion stake. A weak forecasting record. Revenue has landed below estimates in 5 of the last 6 quarters, and the controls are not yet fixed. So they have some issues to work through there. Employees like working here. Do they beat expectations? So we have this new execution tab here. So this is them versus revenue. Miss, beat. And earnings, beat. And then the history there. Is management shareholder friendly? The multi-year drop in share count. Well, that's mostly due to the spinoff. So can't read too deeply into that. How strong are the margins? The margins are improving. All right. I'll go with 4. Questionable, but that's fine. Execution risk. Do we even need to look at this one either? 2 customers are the economic engines, hinge on a single chip supplier, trade policy, power, and capital markets with a strong balance sheet. 2 customers are 45% of sales. NVIDIA is the single chip source, but they have lots of cash. So revenues are very concentrated. Is disruption a threat? 3 named forces exist. Hyperscaler economics and a state-funded capacity, a hardware cycle that can strand fleets, and AI demand that may fall short of forecasts. How much is in their control? And then how healthy are the financials? This is
a 1. Like, this is a 1.
Very high risk. It's got to be. Disagree or agree? Or?
No, I think it's got to be.
it's a insane growth and insane potential. Okay, let's take some time on valuation here. I have a feeling that this is going to be also extremely difficult here. So let's move this to 3 years because we can get that. Price to sales is something that we can look at. It's currently trading at 60 times sales. This number has bounced around over the bid. If we go down to gross profit, a little better on gross profit. Well, that says 82 times gross profit. So yeah, wiping that to account for the spinoff out of place. We need to kind of wipe that off the record. So on a price to gross profit basis, it's about even with where it has been over the last year. You know, it's roughly in line with where it's traded. So multiple analysis here is not going to be really all that helpful. Let's do total addressable market analysis. So when a company is like the future is way unknown, you can do a total addressable market analysis. And we built a tool here. This looks fairly complicated, so we'll walk through it step by step. So we have 3 scenarios: bear case, base case, and bull case. And the first thing to say is, well, how big is the total addressable market for this company?
So I asked Claude before this session to give me its best guess for total addressable market by 2030. Important to point that out. So 4 years into the future. It said for Nebius about 120 billion. The thing is, that's actually not its TAM, it's its SAM. It's its serviceable addressable
Well, that means
market.
it's more accurate.
Right. I agree. But we probably would want to inch up the share that it would get because it's more accurate, if that makes sense.
Sure.
So if the pie shrinks, the size of the pie, the size of the slice within the pie should probably go up.
Yeah. Well, let's make the bull case at least twice as big.
Yep.
Right. For the size of the market. And the bear case, I mean, again, this is just the market size. Half.
Sure.
All right. So we have this is just how big is the pie that the company is going after. And the more accurate you can be. So we're using the serviceable addressable market. If we did total addressable market, that's probably $1 trillion. All right.
Yeah.
Potential market share. What is this company's market share potential? So 20% base case?
I mean, that's the part that I just don't know.
All right, let's go 10%, 20%. Yeah, that 20% and I don't know, 5%, because they already have contracts in place. So they're doing something that is winning over their market. Okay, how high could the potential profit margin be on this company?
It depends on which business model. Is it the one that they've had?
We need the total business model.
Right. So like right now, I say 10% is a reasonable profit margin given all the...
Isn't their gross margin like 70%?
No. Their gross margin, I think was, well, you know what? Let me go back and check. Their gross profit is 70%. Yes. Yeah.
So their gross margin on their business is 72% currently. And they're going after hyperscalers. So in theory, you don't need a tremendous amount of SG&A because you're servicing call it 100 global customers, maybe 500, but you're not going after everyday consumers. So as a bull case, I don't mind saying, geez, 25%.
Well, here's the thing. So you've got REITs that do this, like Equinix. They've got about a mature free cash flow margin, probably around 15%. You've got DigitalOcean, which might have 20%. The tough part about this is you've got to remember that there's the the depreciation and amortization. Like the thing is none of that has really hit the income statement.
Yeah. So to be clear, we're guessing on all of this.
Yeah.
We're guessing. We're trying to make educated guesses.
But and that's the best we can do.
8, 12, and 20. How's that?
Yeah, that looks good.
Yep. Future PE. So we'll call it 15, 30, and 45. That's good. So what will the market cap be under all of these scenarios?
Well, yeah. And one thing, change the target year to, I would say 2030 if you can.
That's only 5 years out.
All right. There we go.
You think it'll get there in 5 years?
I'm telling you what the base case SAM was for 2030. So those were the numbers I was going based off.
Oh, well, let's do 10 years, right? This is going to be a long-term story.
Okay,
So
then we've got to up those numbers.
these?
Yep.
All right, let's 2, 4, and 100.
Yeah. There we go.
There. So this is 10 years out. And then what are the percentages of this actually being true? Maybe let's go 5%. Base case, let's go 15%, and bear case 80%. So if we do that, well, that it's essentially a reverse DCF of sorts with how we're doing that. All right, let's go 10%. 10%.
I mean, but so to be clear, if this looks like it's just kind of throwing darts at a board, that's the point.
Yeah,
that's the point.
This is how venture capitalists think, though, and this is how you need to. This is why we built the tool. It's essentially, if everything goes best case scenario, right? If the bull case is correct, the market share is correct, right? If this company blows out the doors, this could be this is multi-$100 billion company, right? So then you have to say, all right, what are the actual chances of that happening?
Right.
If you think there's a 10% chance of this happening, shares are undervalued today. If you think there's a 5% chance of that happening, you have a 5% chance of essentially 10xing your money in 10 years. Anyway, this is a calculator. You guys can play with it as much as you want when it comes out, but it's at least something to like gauge the valuation of a company that has the future is completely unknowable.
Can you show just highlight that CAGR part? Because to me, that's the most important part, the CAGR part, because you want that number to be above 10%, because 10% is in theory what you can get by just putting it in a low cost index fund.
Well, we can easily make that above 10% just by changing the chance of the bull case being right to
and then you just need to know that those are the assumptions that are baked in.
Yeah. Anyway, it's a way that it's on a trailing multiple basis, this company is expensive, like obviously. But if the growth numbers that we saw in the estimates are to be believed, then the growth is going to be absolutely insane, and trailing numbers aren't going to reflect that. Since we're here, let's just look at the forward numbers too. If we go to ratios, and then we go to forward numbers, forward price to sales, and then let's shrink this down to be common size. So it's currently trading at 10 times forward revenue. 10 times forward revenue. And if we put a line around that, that's essentially right in line with it. Boy, that took quite some time.
I have one last thing that I just have to say.
Sure.
So I went into fiscal, and I have one more year of analyst guidance than you do in it. They are expected to have free cash flow of basically, not exactly, but basically negative $20 billion for 2026, for 2027, for 2028. So let me just say that again. Each year. Now, if you're wondering why they changed their business model, there's your answer.
Yeah.
Because here's the thing.
They can't afford it.
Well, they need customers to prepay in order to find, like, it's got to come from somewhere.
Yeah.
It's got to come from somewhere.
Yep.
Like last I checked, people aren't going to turn over their farmland for nothing.
Yeah. I mean, their market cap is 54 billion. And if they're having negative free cash flow each year for the next 3 years of 20 billion, their whole market cap is going to be paid out in just negative free cash flow over the next couple of years. Wow. Insanely hard to value, insanely hard to analyze.
It might be one of the hardest companies to value I've ever seen.
So let's just say it's expensive. I agree with that. All right. So here we have the total. So I rated the business a 4. It's in the hypergrowth stage. The moat is thin but widening. The growth is off the charts good. It is founder run, and he has a big stake, good Glassdoor ratings, mixed track record with execution, and some internal control things. The risk here is very high. The valuation is very high. So the composite score for me came out at 3. came out about 3. Obviously, the NVIDIA buying a 10% stake, that definitely helps. The launch of the new business model, if they can make that a reality, boy, would that change the free cash flow picture,
It would change everything.
I don't know what you call this company aside from lottery ticket.
Yes.
It's a $60 billion.
And I will add, the more that you understand this industry, like if you work in this industry, if you're involved in building data centers, if you're adjacent to it, if you've got extra info, like that changes things. But we don't do that.
And it seems like the special sauce that they have is our racks can run hotter, so you can get, they're less energy intensive, which is attracting people. They have deals with Microsoft and Meta. And if their new business model works, it is you, external source, fund the cash to build this out. We'll bring the know-how and the customer demand so you can monetize it and probably obviously take a cut for doing that for you. Now I'm going to mark this on my watch list and save it. And with the new stock simplifier, we can click this button right here and get this awesome one-page visual overview of everything that we just talked. So all the ratings that we had at the top, the overview of the business and the mix, the stage that it's in, the CEO, Moat, growth rates, key metrics, and valuation, and more. And then you can save this as a JPEG or a PNG. Wow. All right. That is Nebius down. By the way, if you want access to this stock simplifier that you're seeing on the screen, this is going to be relaunched to our premium users tomorrow. So it's not yet available. It's going to be launched tomorrow around noon. We're going to have a special webinar to kind of show people off all of the features that we built in. So anybody that joins is going to get access to this tomorrow. And if you're already a premium user, it's going to be it's a new link that you have to go through, but it's included with your subscription. So can't wait to get this in people's hands. If you could share the link so that people can try to sign up, that'd be fantastic. Any questions before we move on?
I mean, there's the big thing is just there's a lot of comments about the heating and the cooling, and running hotter means that you shorten the lifespan. And is that trade-off worth it? These are the important questions. And for being honest, I don't have the answers to those questions, because I believe that it probably changes depending on the rates that you get for renting out those H100s. You know, that might change every day.
There you go. All right. On to IREN. That one was fun. Let's see if our head hurts just as much after doing IREN. So this is an Australian company, ticker symbol IREN on the NASDAQ. Mission is to build a leading sustainable Bitcoin mining business that creates long-term value and to progress while protecting the planet. That's quite a lot of mission.
Look at the chart and see if you can figure out when they made the pivot.
Yeah, when did they announce that? All right, some key statistics. This is an $11 billion company founded a couple years ago. The gross margin is nicely positive. Net margin also nicely positive, but it's higher than their operating margin and huge negative free cash flow. Something wonky in the financial statements here. Balance sheet, $600 million cash, but a lot of debt. Insanely fast revenue growth, trading at 20 times sales. And it does have a PE ratio, although I'm going to call that number to be largely unusable. Anyway, let's take a look. IREN builds and owns large data center powered by renewable electricity and then runs its own computing hardware inside of them. So they specialize in machines that complete Bitcoin mining. Okay.
That's what their prior life has been.
Earning coins that are sold for cash, typically within a day. But in 2024, they launched an AI cloud service business. They rent graphics processing capacity to companies training and running artificial intelligence models on multi-year contracts. They own the power and the sites, and they pick the locations where renewable power is cheap. And what's its distinctive? One business takes whatever the price the market sets, and the other is contracted years ahead, and both run through the same electrical footprint. So capacity can be pointed at whatever pays better. Interesting.
I mean, so the interesting thing is they didn't ever have a customer before. They would mine the Bitcoin and then they would just sell it.
Right. Now they do. The two sides of the business sell to completely different buyers, and one of them has no buyers at all. The Bitcoin network. Nobody chooses to buy mining output. Right. It's just selling to a market.
You just buy the coin.
Hyperscalers and large platforms. Microsoft and NVIDIA contract for blocks of computing capacity when they need them. The Frontier AI Labs, Perplexity, Figure, Together, and Fireworks buy capacity because compute is their largest input cost, and they're ceiling on output. And Enterprise running their own networks. Okay. As of last year, fiscal 2025, 97% of revenue was Bitcoin mining. 10% of revenue. Selling Bitcoin and the mining and the selling of it. Yeah. 3% of revenue, $16 million, was AI. And I'm going to guess that 100% of their chart is due to the AI.
Yeah.
They don't break out their regional breakdown. Business quality. How predictable is revenue? Well,
so this is tough because it's using backwards, which AI can only use the numbers that we feed it from fiscal. So,
well, I mean, it is 97% of the revenue was tied to Bitcoin.
Right.
So was revenue predictable? Absolutely not. They were selling a commodity and they have no control over the pricing. Can it raise prices? Nope. Not on that business for sure. How recession proof is it? It's completely dependent on the price of Bitcoin and what's their competitive position. IREN competes credibly against 9 named mining rivals and 14 AI and colocation rivals, leading none of them by any market share figure it discloses. So this is not the top dog in any of them. If the deep dive says anything different, I have a feeling it's going to be a lot of what we just saw. Key metrics, self-mining capacity, AI compute capacity, GPU capacity, cloud run rate, and contracted terms.
So look at, they're looking for 4 billion run rate at the end of 2026.
Yeah, for more than 4 billion end rate by the end of this year, raised from 3 billion, with 85% of that under contract. The company states this is an operating measure, not reporting revenue. Annual run rate revenue target of more than 4 billion. So does that mean at the end of the year, if you were to essentially they're going to be doing $300 million a month?
They'll do $1 billion in
a
Q4
quarter
of AI cloud. That's what
right.
they're saying.
And then if you annualize that, that's their
right. So it won't be
rate.
4 billion for 2026, but it'll be at least $1 billion by
Well,
Q4.
that's an insane growth rate compared to what they did last year, right? Last year was 18 million. Million. Yeah.
Yep.
Revenue predictability. Yeah. So a lot of this is going to be on, again, business model transition. Well, I'll go with my same 4 here for like it. What phase of the business growth cycle is this company in? Phase 3, operating leverage. The company is profitable and choosing to reinvest rather than to return capital. It's expanding, it's profitable and growing, and it's reinvesting everything. Revenue growth has been super high, but that's the Bitcoin. Operating cash flow has been negative in the past. Now it's hugely positive. No buybacks, no dividends.
I mean, honestly, I think it's closer to phase 1 or phase 2, given what's coming. Because its depreciation and amortization is about to start hitting the income statement.
Well, let's look specifically at, okay, revenue is declining. So this is obviously the
Bitcoin falling.
The shift. Oh, yeah, you're right. That's going to be the Bitcoin.
Bitcoin is plummeted.
Right. Do we have the specific segment? Yeah, artificial intelligence. So this is AI by quarter. Right? So 34. So this business is growing.
But there's no way that has positive margins.
Yeah. It might, but they wouldn't be meaningful.
No.
Right?
Right.
Yeah, you can see just how volatile the Bitcoin mining revenue is. And so they're anyway, if by the end of this year, they're predicting this is going to be $1 billion.
Mm-hmm.
From 30 million in Q1. Yeah. Company that's just in the middle of transition. Again, what phase is it in? Neither of these companies fit real nicely into this, but so to keep things consistent, I'll just go with phase 3.
Okay.
All right. Does it have a moat? 2 protections are real and neither is strong. 3 are option outright, and returns do not yet beat the pure field. Thin moat. It owns cheap power, and contracted AI terms are real and neither is decisive. 3 sources, no customer, no patents, nothing rivals can't copy. And cash conversion trials do not give it a moat. But on the flip side, multi-year contracts and prepayments to binding customers longer while owning the cheap power capacity. So the moat is widening. New cloud contracts run 4 years, longer than anything a year ago. Customers prepay. The recent deals funded 45% of the associated GPUs, and the own capacity is scaling. Self-built power went from 3 to 480 in 12 months.
That's the big thing, is the fact that they built something for Bitcoin. And it just so happened that what they built to make their Bitcoin as profitable as possible, owning the power, owning all of these GPU clusters, is the same thing that AI is looking for.
And it's a very smart business model transition, if to say nothing else, that this is what the market is rewarding right now, very, very clearly. Probably to be more sustainable business, and it also eliminates the volatility of selling the Bitcoin thing. It's a very sensible business model transition. It just makes, again, the analysis really hard. I like the 4-year contract thing and the prepayment. That to me does build out some.
I think the power is part of the key part too. If you have cheap renewable electricity that you have control over, there are not many players that have that.
Sites are chosen for cheap renewables. Over 80% of its capacity in the United States, and the rest is in British Columbia, which is the main recurring
I think Texas is where most of it is.
Okay. All right. So historically,
a 2 and a 4. That's what I would do.
That makes sense to me. Growth. I wonder what the growth is going to be. Revenue is compounded 100% and exceptionally fast pace, but they own their own record. Disagree too wildly on what it can be. Recent quarters went backwards, so revenue fell because mining expansion was paused, and the AI revenue has not started to load. The next leg is contracted again. Let's go to fiscal. Let's see if we can go to annual, because you have a declining business and an accelerating one. I don't see estimates.
Yeah, they don't have estimates for segments and KPIs, but you can do that for revenue.
Okay. Revenue. So next year, 737, and then 3 billion. Yeah. Again, insane.
Year after that, it's 6 billion for what it's worth.
6 billion.
Yeah.
What's the growth rate? Insanely high. Just no need about that. Founder, co-founder, chief executives with 166 million in stock. Executive, a hard pivot to against 7 revenue misses in 8 quarters and heavy dilution. So the founders, they still run it, and they each hold the part of the business worth 166 million. The pivot actually landed, pausing the mining and growing it, but the numbers are not bearing that up.
The other thing that's worth mentioning, and this happened very recently, so it might not have made the most recent update to Stock Simplifier, is they have a new approved pay package that was very good to these 2 co-founders. I believe it was $10 billion each. And how big is this company again?
This is a $10 billion company.
Yeah, so maybe I'm wrong about that number. I can look it up. But the performance metrics that it was tied to were pretty weak.
Okay. And you can't really fault them, too much, because they have no control historically over the price of Bitcoin. And that was going to be what revenue is, and that is going to be what earnings are. So that's the reality of operating a cyclical business.
Yeah.
I would say you can start judging them on execution, more on contract signed, megawatts brought online than necessarily revenue.
For what it's worth, it says that those 2 could out-earn Jensen Huang
because of their pay package.
Because of their pay package.
Is that on the company's website somewhere?
I'm just looking up. I remember I read about it when it came out, but if you look up IREN executive pay package, there's a bunch of stories about it. Yahoo Finance ran a story. This was about 10 days ago. So again, this is, let's see. It was a $1.2 billion pay package. Yeah. That's 10%.
5% dilution each. Okay. Either way, big. It's very clear that they are enriching themselves.
Yes.
And
my 10 billion was the wrong number.
Right. And the numbers do not back this up yet. So I'll say decent as as more of a hedge. This is not a great management team as of yet. We don't have enough information to go off of there. Execution risk. All 4 risks now sit at their worst reading at once, and the company is funding a $1.3 billion a quarter build on revenue, still set almost entirely by the price of Bitcoin. So the
That's
business
going to change very soon, though.
This year, this is a pivotal year for them, and the customer prepayments should help. But how diversified are revenues? Again, this is on last year, completely concentrated. Is disruption a threat? These are all going to be against Bitcoin and the thing, but no doubt about it. The risk here of a complete business model transition, very, very high. Yet another, again, valuation. How are we going to value this company? Okay, so trailing PE is going to be utterly useless to us because the business shouldn't be valued on that at all. Price to sales even is quite challenging to use because sales are going to be moving around so much. Reverse DCF, even if reverse DCF, as useful as this is, doesn't make a ton of sense because this is not going to be a free cash flow machine for quite some time.
It's expected. So it's expected to lose $20 billion total over the next 3 years.
Well, that's better.
Only got 500 million in cash.
Yeah. Well, let's go to fiscal and we will do a forward price to sales because again, that's probably the best one for this. So if we go forward price to sales, yeah, some wonky numbers to there. And this is all based on the trailing Bitcoin stuff. Wow. When numbers are in transition as they are, it's going to be a really hard company to value. I wonder if we can look at price to book. Price to book. Yeah. This company used to trade at essentially book value. Now it trades at 5 times book value, but the growth here is going to be super high. Yet again, I don't know really how to value IREN. It's just going to be, can they execute against what they have stated they're going to execute against? And I'll just say it is expensive. So revenue growth here is the thing to watch, the competitive moat widening. And here is the overall view on it. I will also put this on my watch list. So to summarize, business is massively in transition. Used to be a Bitcoin miner. Now it's taking that capacity and putting it towards AI compute. The business is in the operating leverage phase, but the Bitcoin is probably in the operating leverage. The newer business is probably losing money. Hard to kind of suss that out given the breakout. Not much of a moat historically, but the moat is growing with the contracts that they've signed. The growth is going to be off the charts for the next couple of years. Questionable management, depending on how you look at that, extremely high risk. And looking at the valuation, I mean, one way to look at the valuation that's probably pretty simple is it's a $10 billion company. What do you think it could be worth if it all works out? So 50 billion?
To me, the way that I read this, and this is from 30,000 feet, I am not invested in either one of these companies. The idea here is the big advantage to IREN is like more vertically integrated. They own their renewable energy, and that's a big deal until it isn't. I think it's going to be a big deal for a while. On the flip side, I also very much agree with what one of our YouTube users says, which is that I've dug a little bit into this when I read about those pay packages, and it sounds like there's some discontent. I know there's discontent in the investor community about those pay packages, but these were Bitcoin miners that transition. The leaders of Yandex do, like, missing guidance notwithstanding, they have a reputable track record of over 20 years, and that's something. So I'm just throwing that out there.
Yeah. So I'm curious. Well, you pick first. I know what I'm going to say. IREN versus Nebius. If you had to pick one, which one would you go with right now?
I would go with Nebius.
Because?
I would go with Nebius because you know what? I actually owned Yandex. Like, it's been like 7, 8, 9, 10 years since I owned it. But I did a lot of research on the founders. I think I think that they're talented. I think they know what they're doing. I think that they are taking on a bunch of risks, but on something like this, the management team is everything.
The bet.
So that's why.
100% agree. I'm going with Nebius's too. I'll add in another reason. So first off, everything you just said, when you're betting on a transition in a brand new market like this, the execution and the management team is the thing that you should really focus on. So from the management team perspective alone, I like Nebius's management teams better than I like IREN's management team. The second thing I'll point out is access to capital is going to be something that these companies need. The market cap of Nebius right now is 50 billion. IREN, it's 10 billion. And I like the move that Nebius is making with the business model transition. It just put up on its website to basically say, hey, we can bring our know-how, you bring your capital, almost turning the data centers into like a franchise.
Well, it's almost like they're a consulting firm then. With their own software, but
taking a extremely capital intensive thing, putting a spin on it that could make it capital light. Now we have zero proof that it's a press release right now. It's just talk right now, but that seems like a smart way to do it. That seems like a smart way to do it to me. And they have the advantage of, their advantage seems to be, we have the technology that allows our servers to run hotter for longer, which could reduce the operating expenses. To be clear, I view both of these businesses as lottery tickets right now. At the All In Summit a few months ago, there was a slide on the screen by, I think it was Co2 Asset Management, that blew my mind. And the slide was, what are the odds of a company 10xing based on its market size? And if it was, I'm going to butcher the numbers, but it was essentially, if you're a $10 billion company, the odds of you becoming a $100 billion company were like 8%. If you're a $100 billion company, the odds of you becoming a $1 trillion company were like 30%. So the bigger you were, the higher the Lindy effect, the higher the odds of you getting to the next 10x level. So because of that, I think that focusing on big companies is actually the way to go, especially when the market is changing.
It's counterintuitive.
Like this. It's completely counterintuitive. Counterintuitive.
Because we never pay attention to the $10 billion companies that never become $100 billion companies.
Yep.
We only pay attention to the small set that do.
Right. And you might be thinking, IREN has a $10 billion market cap. You might think, oh, if that's a 10x if it becomes $100 billion, whereas Nebius is a 2x if it becomes $100 billion. And they're both dice rolls at this point. With they're better than a dice roll because they do have operating businesses. They do have agreements in place. I'm probably being too harsh on that perspective, but they're still extremely risky. But for me, I would choose Nebius, and I'm putting $0 of real capital behind that decision. How about you?
Same. For right now, the same. I reserve the right to change my mind, but same.
There you go. Well, these were two extremely difficult companies.
This is the hardest we've done.
Yeah. They basically just to the left of two biotechs that we're trying to analyze here. But I hope that we illuminated, if you're interested in or know a little bit about either of these businesses, I hope we provided some light on what they do and what the bet is going to be on either of them. Thank you guys so much for spending time with us. We'll be back next week where we'll take a look at two other companies. Hopefully they're much easier than the ones that we just did. And if you are a Stock Simplifier premium user, join us tomorrow. We're going to be doing a private webinar. We're going to be going over all of the details of the new platform that we launched and that we just showed you. So we really hope
watch your email.
What?
Will they get an email about that? So they can
I already sent an email out yesterday,
Great.
But if you sign up today using the link that Stoffel is sharing in the chat, we'll send you an email with an invite to that and everything like that tomorrow. So, wow. Let us know if you guys like, again, this format of two stocks over an hour-long period. If it's more helpful than just doing a deep dive on one, we would love to hear any feedback that you guys have about this style of research. Great. Damien, it's at 12 o'clock Eastern Standard Time. So Eastern time. Yep. And Brandon, if you're still on the beta, which everybody is right now, we are going to be sending out the new links and everything you need to know tomorrow. Absolutely. So one more day of waiting, and then you'll get it all. Awesome.
All right.
Cool. Woof. Hope some We picked these companies because people voted on them in our newsletter, and we put them up there thinking, hey, people are interested in this. My head hurts after
we bit off a lot.
Yeah. Well, thank you guys so much, and we will see you next week and premium users tomorrow.
Bye, everyone.
Bye, everyone.